Hello and welcome to a session on capital budgeting. For this session, our assigned readings will be Ross, Westerfield, and Jordan, chapter 7 and 8. Now, we have come to accept the notion that the goal of any financial manager is to maximize the wealth of shareholders. So clearly, this financial manager has to make sure that the firm increases in value. Now, to be able to maximize this wealth, then first we must create it. And how do we create wealth? Wealth is created when we invest in projects that bring in more than they take out. So at the end of the day, it's a net positive position. So for the finance manager to be able to identify and select such value-adding projects, i.e. projects that bring in more than they take out to the firm's portfolio, then they have to apply certain skills. And that is the capital budgeting process. That is the decision points that helps the finance manager to identify viable projects that fit the company's strategy. At the end of this session, the students therefore should be able to describe the entire capital budgeting process, including the typical steps that go into the process, distinguish among the various categories of capital projects, and be able to apply various techniques for the purposes of selecting viable projects from a pool of projects. Now, let's start by introducing ourselves to capital budgeting. When we talk of capital budgeting, it just means that we are trying to allocate capital to long-lived projects, or that we are trying to budget for capital assets. So when we talk of a capital project, this is usually a long-term investment in tangible projects. The principles and tools of capital budgeting can be applied in many different aspects of a business entity's decision-making and in security valuation and portfolio management. Now, it is important to note that how well a company does its capital budgeting would go a long way to determine the value of the company. Because like I earlier mentioned, when a firm is able to identify viable projects, meaning projects that will cost less but bring in more, then of course, with every project, more value is added to the company. Now let's try to understand the capital budgeting process. So clearly, a firm would normally have a strategy as to where it wants to go and what it wants to do to fit its environment. And so with a broad direction that it wants to take, at any point in time, projects will come up by trying to generate ideas. So ideas could be generated. So let's take, for example, that a firm is into providing training, consulting, education, etc. Given their ultimate goal, they would come up with ideas as to what new training program, for example, they should come out with, what new academic program they should come out with, what new brand of soap that fits a particular skin type they should come out with, for example. So these ideas can be generated from both inside and outside of the company. It could come from engaging the employees, from engaging the customers, which is usually what some firms try to do. So take, for example, the issue of Coke. They came up with various versions. So they have a Diet Coke, and then for the Sprite as well. So they come up and generate ideas looking at both what may be happening, intelligence they have gathered from inside or outside of the company. Now, the next step will be to analyze the individual proposals. So collect the relevant information and analyze the profitability of the alternative projects. Once this analysis of individual projects have been done, then you want to see the one which best fits. So quite a number of proposals come up, but then you want to look at which best fits and which one also brings in more value. And then the final step will be after implementation, you do monitoring and post-audit, meaning that you want to compare the expected results with the realized results and explain any deviations. So what it typically means is that for the finance manager, your job at this point is to be able to put together the relevant details that will allow the firm to derive value out of their allocation of capital to such long-lived projects. Now let's try to classify some of the projects. So yes, capital budgeting projects can fall into various categories based on the ultimate goal. So there are times it may be a replacement project, meaning that a machine that is being used has now outlived its economic life or usefulness, and the institution wants to replace it. And so they're going to look at the various options available for replacement and look at which one brings in more value. Then there's also the issue of expansion. So sometimes that could even mean, for some, that actually could mean adding on a new product line, expanding the same service to another location, etc. Then we could actually have totally new products and services coming up to add on to the existing portfolio. And there are other projects that fall into regulatory safety and environmental projects. And you see this typically within the extraction sector, the minings, etc. And then we have other projects in general. For as long as it entails the allocation of capital to long-lived projects, it falls under capital budgeting projects. Now let's look at some of the basic principles that you need to keep in mind as you proceed with the capital budgeting assignment. Decisions are based on cash flows, not profits. So whenever we're making decisions on capital budgeting, our focus is on actual cash flowing in and out of the organization or flowing in and out as a result of the project. Two, you have to take note of the timing of the cash flows because this is crucial. The timing is key, and that will come to understand further. Now, you must also keep in mind that the cash flows that we focus on are incremental cash flows. The golden rule for the incremental cash flows is here, that your focus is not on past costs of cash flows for that matter, but is more futuristic, and it is incremental here is what has occurred or cash flows that are occurring because of the project. So normally you get that by looking at before the project, what were we getting? And by adding on the project, what is our total position? Now that difference is the incremental cash flows, which you focus on. And then you also try to focus on cash flows on an after-tax basis. We ignore financing costs because when we have to do the discounting, typically, we account for the cost of capital in there. So we do not subtract financing costs when we are generating the cash flows, because then that would result in double counting. Now, when it comes to investment appraisal or capital budgeting, you need to watch a number of costs that you have to take into cognizance as to whether to include or to exclude. One of the key ones we want to look at is sunk cost. When costs has already been incurred, even on account of a project, for example, a feasibility study, a market research, that cannot be part of the incremental cash flow. Remember, the concept of the incremental cash flow has to do with the fact that you're looking at what is coming up and therefore is arising as a result of the project being implemented. So there are times you may actually undertake a market research and based on the findings, determine that the project is not worth it. For as long as that spending has been done in advance of actually rolling out the project, even if the outcome was positive, for as long as the spending was done before the implementation of the project, that becomes sunk cost, and we do not capture that as part of the cash flows. We also have to take cognizance of opportunity costs. Now, let me give you an example. If you have a building and you're thinking of running a new academic program, for which reason you could put that building to use, it would be inappropriate to factor this building into the project without looking at the costs. So what it means is, if you could have rented that building, then that rental cost should be captured in the cash flow projections to acknowledge or to take note of the implications. I come back to the issue of the incremental cash flow and indicate that it is the difference in the firm's cash flows with and without the project. And so that's the additional cash flow as a result of the project. We also have to take care of externalities. Now, externalities are effects or outcomes that occur that are not necessarily anticipated and which still have relevance as far as the cash flow implications. One of the well-noted ones is cannibalization, in which the investment reduces cash flows from elsewhere in the company. So let's take the existing regular Coke and Diet Coke. Now, before Diet Coke came in, most people who wanted Coke drank normal Coke. But of course, with the introduction of the Diet Coke, a number of Coke lovers are likely to switch to Diet Coke because of their preference for maybe a non-sugar connotation added. Now, that means that regular Coke is going to experience a drop in revenue, and part of that will show up as the revenue stream for Diet Coke. So of course, by taking cognizance of that and looking at the incremental cash flow as well, it gives you a clear sense of what real value or what real set of cash flows the Diet Coke will be bringing in and whether that justifies the investment. Now, we need to also take note of the cash flow patterns that come along with projects. We can have conventional cash flow patterns. Usually that means we have only one sign change over the life of the project. And usually with a conventional, it means we invest in the present and then we reap in the future. So you can see that in terms of today and maybe a year from today, on the second line, we invest, or we can invest and wait before. But once the cash inflows come in, they are positive throughout. These constitute conventional cash flows, which then take us to the non-conventional patterns. With the non-conventional patterns, we have this erratic move from positive to negative cash flows over the life of the project. And these patterns need to be taken, you need to take note of them as they have implications for the outcome of the capital budgeting process or the investment appraisal process. Now, there are times when you're also faced with some projects that may be independent or mutually exclusive. Independent here means that if you pick one, you could pick a second. Mutually exclusive means that you pick one and you cannot pick a second. So at that point, those decision points can result in varied outcomes. So independent projects, you accept one and you can accept another. It doesn't stop you from accepting. Mutually exclusive, one means you cannot accept the other. And then there are also capital projects that may be sequenced, meaning that you have an option to invest in another project as you go on. So sometimes there are real options associated, whether to expand or abandon the project after a particular sequence has been completed, after you review the performance of the initial project. Then, of course, capital is quite scarce. So it is not rare to find the scenario that firms could be limited by capital. And so when the amount of expenditure for such capital projects for a given period is limited, the firm then is constrained to try and maximize the available capital by choosing the most viable project. So if the company has so many profitable projects that the initial total expenditure will exceed the budget, then the company's management must determine which of the projects to select. And bear in mind, the objective is to maximize the owner's wealth. And so they'll pick the most viable, which also results possibly in the rejection of other profitable projects. Now, having put all these things in perspective, now let's move on to the investment decision criteria that are typically used. We have the net present value, the internal rate of return, the payback period, the discounted payback, the average accounting rate of return, and the profitability index. Usually these can be broadly categorized into discounted cash flow techniques, meaning that they use the time value of money, and then the non-discounted cash flow techniques. Now let's start with net present value. Now, net present value in simple terms can be seen more like some kind of profitability analysis. So if you have a project that has a 5-year lifespan, has a 10-year lifespan, you can determine the cash flows for the economic life of that project or the life of the project. Now, once you're able to determine the cash flows, with your understanding of time value of money, then it doesn't necessarily make sense to just add the accounting values in their raw sense and then subtract the cost, which is normally what we would do. Instead, you're going to now discount the individual cash flows in the years in which they are received, so you can arrive at a present value, a consolidated present value of all cash inflows. And then you subtract from the initial outlay, which is the cost. And so that literally, in a sense, is giving you profits that has been time weighted, or profit that has accounted for time value of money. So strictly speaking, it is the cash flows that you derive over the life of the project, discounted appropriately, less the outlay. So of course, where the CFT is the after-tax cash flow at time T, the cost of capital is the required return, and then the outlay is the initial investment or the investment outflow at time 0. So it makes sense, therefore, that if by doing this kind of modified profitability, which takes care of time value of money, if the project, meaning, remember this is, you've analyzed the entire cash flow over the life of the project, that means over its entire life, and the profit position is less than 0, it means this project is a loss-making project because negative profit is unacceptable. So then the rule for NPV will typically then be that if the NPV is less than 0, you reject the project. And if the NPV is greater than 0, you accept the project, meaning the NPV, if it's greater than 0, is positive. And that, in a sense, tells you that if the NPV, given the entire lifespan of the project, is greater than 0, it means it's a value-adding project. And that is why, for any typical firm, you'd want to pick the project that has the highest NPV, because that's what adds the highest value to the firm and helps in achieving the purpose of maximizing shareholder wealth. So now let's look at an example here. So Hofstad's projects, which requires them to invest 1 billion initially, and then over the life of the project, we're going to be receiving 200 million, 300, 400, and 500. So when we put this into the cash flow table, so you can see immediately is $1 billion. And then for the next 4 years, we have our 200. Now, if we are told that the cost of capital is 5%, it means you're going to discount these cash flows at 5%. And when we finish, we're going to sum up the cash inflows for years 1 to 4 and subtract it from the cash outflow or the initial outlay. And that gives us this. So based on the example, we have an NPV of $219.47 million. This means that should we undertake this project, we're going to add on an extra value of $219.4 million after we have adjusted or taken care of our costs of production or cost of setup, which is the $1 billion. And so this is a value adding project, and all things being equal should be undertaken. Now let's look at the second approach, which is referred to as the internal rate of return. So the internal rate of return is typically saying that over the life of the project and based on the anticipated cash flow, what is the rate of return on this project? Now, the reason you would want to know this is because when you know the rate of return on such a project, then it tells you that based on how much it will cost you to raise money for that project, you can tell whether the project will be profitable or not. So once you're able to find the internal rate of return, then what you do is to compare that to your cost of capital. So remember that your return is how much you will garner from this project in terms of rate. And then the cost is how much you're paying to raise capital for this project. So if the return exceeds the cost of capital, then by all means, invest in the project. If on the other hand, the return is lower than the cost of capital, it means you're incurring more costs than the return that you're garnering. And of course, that means there's value destruction here, which therefore means that when the cost of capital exceeds the internal rate of return, the decision point is to reject the project because it will cost more than it will bring in. Remember, the principle is to get something that brings in more than it costs, meaning it costs less but brings in more. So those are the rules. So when you put them together, it becomes quite easy. When NPV is greater than 0, it means positive profits, time-weighted profits, accept. When it is less than 0, negative profits over the life of the project, reject. When it comes to internal rate of return, higher return compared to cost of raising capital means accept the project. Lower return, meaning that the cost is higher than the return, reject the project. So those are the rules for NPV. We shall focus more on our tutorial sessions to solve more questions. So now let's try a look at that example. So now the internal rate of return is almost akin to the YTM, meaning the yield to maturity, because it makes the price or the present value of the revenue streams. Remember that typically when you're even doing bond valuation, the price of a bond is typically the discounted value of the revenue streams expected. So when the revenue stream and the price, the costs become equal, we normally say that it means that NPV for the particular project is 0. So the rate of return when used to discount a project that results in an NPV being equal to 0 is construed as the internal rate of return for the project. So the IRR is the rate that solves the formula work that you see above here. So note that by putting in this, we are able to try different values, and then we arrive at the position of 12.826 as what will result in an NPV being equal to 0, meaning that it will equate the cost of the project to the discounted present value of the revenue streams. Now let's look also at payback period, which in this case is a non-discounted cash flow technique. The payback period is the length of time it takes to usually recover the initial cash outlay on a project from the future incremental cash flows. So if we were to use the first example of the Hustats project, for example, payback occurs in the last year, year 4. So if you look at it closely, these are the cash flows. And then we started by outlaying an outlay of 1 billion. At the end of year 1, without So when we look at the payback period, like I said, we are looking at the time it takes to recover the initial outlay. So we are back to looking at the cash outflow at the very outset, which is 1 billion. And at the end of year 1, we are able to accrue 200, which then reduce existing or outstanding debt to 800. By year 2, we get another 300, which reduces us to 500. And by year 4, that reduces based on the 400 to 100 million. Now, by year 4, then we're going to have 400, but all we need is an extra 100. So somewhere in the early part of year 4, we are going to be able to recoup. So assuming, so we're only recouping an extra 100 to be able to recoup the entire, and then we'll be left with an extra 400, which makes up this. So that's for the payback period. So that's for, now, when it comes to payback period, usually it seems to have the shortfall of sometimes ignoring cash flows, because let's take a look at these two projects we have, Project X and Project Y. Now, both of them have similar patterns of cash flows, except that in year 4, Project X has an extra £60 to give. So if you were to look at both of them, Project X and Project Y would have similar payback periods, because when we move this and we get to 80, and then we get this to 30, between the early part of year 3, we are likely to have a payback, which means that ordinarily speaking, we will be indifferent between Project X and Y. However, if we were to use the payback without looking any further, what will result here is the fact that we may end up potentially choosing Project Y, when in actual fact, this could be a more valuable project. And so that's for a drawback to the payback period. It seems to have a short-term flavor to it, and for that matter, can actually also ignore value addition from later years. Now, the discounted payback is just a modified version of the payback, where while still focusing on the length of time it takes to recoup the capital, this time around the cash flows are discounted so that it incorporates time value of money. So let's look at the two examples, Project X and Y. When we discount the cash flows, these are the values that we get. So clearly you can see that still by the 3rd year, the two of them will proceed to pay us back. But cumulatively, Project X adds on more value. And so, but then using this approach of payback, there's no distinguishing because your payback is you're focused on the time, and the time in this case will be somewhere in year 3. We also have an average accounting rate of return, which is just the ratio of the average net income from the project over its life to the average book value of the assets in the project. Now, this is one of the simplest approaches, and all you do is to look at the benchmark that you have. And if the average accounting rate of return fulfills that benchmark, then you accept the project. But bear in mind that this does not take into account the time value of money. Then we also have the profitability index. Now, the profitability index is just trying to map out a ratio of the present value of future cash flows to the initial outlay. Now, what it means is that if the present value of the future cash flows exceed the initial investment, then of course you would accept it. What it also means is that the profitability index can be captured as 1 plus the NPV, remember that, divided by the initial investment. Now, if profitability index is greater than 1, what it means is that we are able to recoup our initial investment, which is the 1, the base, and have some more. So it means we are to invest because the capital project adds value. If on the other hand, the profitability index is less than 1.0, it means do not invest. It means do not invest because the project destroys value. Because if the profitability index is less than 1.0, what it means is that it is not able to recoup the initial capital that was made or the initial investment that was made. And that means it is not bringing in more than it costs. So at any point in time, you should be guided by the principle of whether you're getting more than you are investing. So let's look at an example here. In the Hostess project, we know that the required rate of return is 5%. If the cash outflow is 1 billion, and we have our cash inflows of 200 million, 300 million, 400, and 500, we are told that the present value of the future cash flows is 1.219.47 million. Therefore, our profitability index, when we take 1219 divided by 1 million, we get 1.219. Now, this is greater than 1, and so it means we are to accept the project. If you look at it closely, this ties in with the fact that we had an NPV of 219.47 when we used the NPV approach. So someone decides that, okay, you want to see how sensitive a particular project is to changes in the cost of capital or the required rate of return. Now, when you map out several projects or one project with several rates of return to see what changes occur to the net present value as the interest rate or the required rate of return changes, the resulting graph is referred to as an NPV profile. And so that can tell you how sensitive the particular investment is to changes in the required rate of return. The steeper the slope, the more sensitive to changes in interest rate, and therefore you could infer as being riskier. And the flatter the slope, then of course, the less sensitive it is to changes in interest rate. Now, bear in mind that at any point on the line where this profile crosses the x-axis, at that point, remember, NPV is 0 at this point. So this is the positive end, and this is the negative. At this point, when it manages to cross this line, which corresponds to NPV is equal to 0, we have attained the internal rate of return on the project. And so that is the case. So this is an NPV profile that was captured for the Hostess projects. And then we can see that by the time we hit somewhere between 20 and the next one being -4, we have transitioned from a positive through to a negative. So the rate that corresponds here is what is construed as the internal rate of return. Now, usually when the cash flows are conventional, NPV and internal rate of return usually would yield the same results. And also when the projects are independent, then of course, if you accept when NPV is greater than 0, now when the projects are mutually exclusive, you usually want to accept the NPV is greater than 0. However, it may not always tally with the case that the internal rate of return being greater than the cost of capital. Now, the source of the problem is that in some cases, whilst a project may produce an NPV greater than 0 and also have an IRR greater than the cost of capital, the scale of the investment could result in one yielding, let's say, an IRR of 50% compared to an IRR of 5%. However, in terms of value addition, if the 5%, let's say the differential, so meaning that, for example, if you have a project and one of them is giving you an IRR of 15%, and another one is giving you an IRR of 50%, for example. And of course, we have concluded that the cost of capital is quite small, maybe 5%. And so both fulfill the mandate of having an IRR in excess of the cost of capital. The tendency would be for one to select the project with the IRR of 50% compared to the 15%. But if we were to look at scale, if the project that is earning the IRR of 15% is actually bringing in billions of dollars, whereas the one bringing in the 50%, the 50 is only bringing in thousands of dollars, clearly the decision will be to go for the investment that appears to be giving a smaller IRR, but in reality is adding more in terms of value. So when it comes to the net present value, the assumption normally is that we are reinvesting the cash flows received over the life of the project at the required rate of return, which is more realistic, whereas the internal rate of return assumes that we are to reinvest the cash flows at the internal rate of return, which may not always be the case. So the problem, like I indicated earlier, becomes more evident when there are different patterns of cash flows or different scales. So the scale issue I did mention is here. Now let's look at two examples or two scenarios here. So we have project P and project Q. Now, if we look closely at project P, it takes an initial outlay of 100, and over the first 3 years returns nothing, and then returns 142 in year 4. Whereas project Q returns 33 every year for 4 years. Now, as a finance manager, you have to look at and decide which project is preferred. And of course, the next question we want to answer is why. You can look at it and say, what are the project's required rates of return? Now, when we do at 0%, meaning zero cost of capital. Project P yields 42, and project Q yields 32. So clearly in terms of NPV and a 0% cost of capital, we're going to accept P and reject Q. When the interest or cost of capital goes up to 4%, NPV for project P drops to 21, whereas NPV for project Q drops to 20. It means we are to accept P once again and reject Q. Now, when the cost of capital rises to 6%, project P now results in an NPV of 12, whereas project Q actually results in an NPV of 14, meaning now the position changes. At 6%, the preferred project is project Q. And then at 10%, the preferred project is project Q. And clearly at NPV with a 14%, we are going to reject both. However, if we were to make a decision to even accept the least costly projects, then we may accept a project Q. So clearly you can see a difference here. When we look at the internal rates of return, you find that project P gives us 9.16%, whereas project Q gives us 12.11%. Now these clearly give us some conflicting data to work with, because when it comes to internal rate of return, it appears that project Q is the preferred one. Yet at certain different rates for cost of capital or required rate of return, project P seems to be the preferred project. And so by putting together the NPV profiles that we have generated, you can see that the NPV of project P is a bit steeper compared to the NPV of project Q. So what it also means is that you can see that before the two lines cross, which typically means the hurdle rate, you find that project P seems to be doing better. But after the crossing, project Q seems to be giving much better returns than the other. Now, this issue now, there are cases where for a project with unconventional cash flow patterns, the signs can change. The cash flow signs change more than once during the life of the project. We could end up with more than one rate that can force the present value of the cash flows to be equal to 0. Now, when something like this occurs, we normally refer to that as the multiple internal rate of return. So in other words, you don't find one unique internal rate of return if the cash flows are non-conventional. So let's look at this. So consider the fluctuating capital project with the following end of year cash flows, and these are in millions. So you can see that the initial outlay followed by a positive cash inflows, and then a negative cash flow. So now we need to determine the internal rate of return. Now, by doing the profile, this is what we end up with. So at one point, at 2.856, the profile crosses the 0 NPV point, which means we have an internal rate of return. And then it goes on and it's positive and then flips again to a point where the rate of 13.249. What this then means is that here we have two internal rates of return. Now, assuming, for example, our cost of capital is 20%. Which of the internal rates of return are we to apply? Because if we are to apply the 2.856 as the internal rate of return, automatically means we are to reject the project. However, if we apply an internal rate of return or accept that it is 34.249, then it means that with the cost of capital of 20%, we can accept the project. These are obviously conflicting outcomes using the internal rate of return approach. Now, when that happens, usually the preference will be that you go to the NPV approach, because then that tells you exactly how much value or how much extra money is being added to the firm. So now in terms of consistency, NPV and IRR are still the preferred choices. Larger companies tend to use NPV and IRR over the payback period. And so whilst it still has its failings, the payback period is normally used, and usually by smaller firms, usually also because sometimes they lack the expertise to be able to apply the NPV approach. So the NPV is more of the estimated added value from investing in the project. Therefore, this added value should be reflected in the firm's stock price. Now let's look at how we go about our cash flow projections to be able to compute the NPV of a project. So first, we need to be able to put together what constitutes the investment outlay. And then we're going to go through the financials and come up also with the after-tax operating cash flows for the life of the project. And then in the final year, whether there are any terminal non-operating cash flows, such as salvage value from the sale of the residue from or the scrap of any machinery, and maybe the dissolution of working capital, so the net working capital being dissolved back in. So these are the basic details you would need to be able to compute the NPV of a project. So how do we come by the after-tax operating cash flows? So of course, first we should be able to generate sales, meaning that if you have an estimate of the quantum of products or services to be generated and the price per service or etc., you should be in a position, therefore, to generate the sales revenue. And then you also compute the operating expenses and subtract from that. And then, of course, depending on which depreciation approach you are allowed to apply, you subtract depreciation, which then gives you operating income before taxes. You take out the taxes and you have operating income after taxes. Remember, you would ignore the financing cost because it will be accounted for in the discounting. And then you add back depreciation, because depreciation is a non-cash expense. And since you're looking at cash flows, you add back depreciation, which then gives you your after-tax operating cash flows. Then, of course, we can also look at terminal year after tax non-operating cash flow. So like I mentioned, if there's a possibility of a salvage value, which comes in, once you get the salvage value, you apply the tax on that revenue stream, then add on the working capital that has been released from the project, and then that gives you non-operating cash flow. Now, a few issues on cash flow projections. So we're going to look at depreciation, replacement decisions, and inflation. So some basics. When it comes to inflation, we normally would want to either work out our cash flows by working through the money terms, meaning that you're going to use a Fisher's equation, for example, to be able to derive your nominal costs or required rate of return, which is the nominal interest rate to be used. Or in the event where that is provided, you can also compute NPV in real terms. All things being equal, there shouldn't be much of a difference between the outcomes. Now, there are times when inflation could be affecting different aspects of the project. And so maybe prices could be inflating at a different path to cost, etc. You would need to take note of these and apply them accordingly. So for example, the effect of sales may not be the same as operating expenses. Note that depreciation is not typically affected by inflation. And then we also note that the fixed cost nature of payments to bondholders may sometimes result in a benefit or a cost to the company, depending on the inflation relative to expected inflation. Now, some questions which we have addressed briefly earlier, and then if we are looking at mutually exclusive projects that have different useful lives, what do we do? And also what happens under capital rationing, and how do we deal with risk? Now, these are things you would have to take cognizance and address as a finance manager, because that contributes to your ultimate goal of value addition. Now, when you are comparing projects with different useful lives, you cannot simply compare NPVs, because the timing of replacements of the projects will be different. Hence, the number of replacements between any of those two projects will be different in order to accomplish the same function. So there are a number of approaches you can use. One of them is to determine the least common life for a finite number of replacements and calculate the NPV of each project, or determine the annual annuity that is equivalent to investing in each project ad infinitum. So what we normally refer to as the equivalent annual cost or equivalent annual annuity. Now let's see how that plays out. So let's look at two projects. We have project G and project H, for example, both with a required rate of return for 5%. But we can notice that project G has a lifespan of 4 years, whereas project H has 3 years. Clearly, it would be difficult to make a decision, even though the NPV of project G appears higher than project H. It actually has longer or more cash flows. And so this becomes heavy. So you have to find a way of making them sort of equal, meaning that if you look at project G, it has 4 years, project H has 3 years. The least common factor between them would be 12, meaning that if you run 12 sequences, meaning that you're going to have 3 times of project G, and you're going to have 4 times of project H, you're going to more like equalize their lifespans. Then, only then do you proceed to making that decision. So you can look at it clearly from here, that if we were to repeat the sequencing for project G and H, we're going to have 3 layers of 6.38, and then we are going to have 4 layers of 6.12. Now, when we now look at the NPV of each and account for that accordingly, we will end up with project G plus 2 original replace or 2 replacements, giving you 17.37, whereas project H, which will require 4 sequences in total, gives us an NPV of 21.69. Clearly, by making their lifespans equal, we end up choosing project H over project G. Whereas if we had gone with the original data, we would have chosen project G over project H. And so these are some of the things you keep in mind when you're doing what we call replacement chain. So this is what we have. Now, when you have the equivalent annual annuity, if you were to have a PV, so 6.38 versus 6.12. Now, what you ask yourself, if you were to rent, given the cost of capital, so if the present value, if you use the annuity factor, then you want to find out what constant payment will give rise to the 6.38, and for project G is 1.80. And then And then for project H, it gives rise to 2.25. So clearly project H will be paying you an annual amount of 2.25 for 3 years, whereas if you were to do a 4-year repayment or annuity framework for project G, it only returns 1.8 constantly for 4 years, whereas this one returns 2.2 constantly for 3 years, given the same cost of capital. And that tells you that project H is preferred. In this case, it returns more than project G. Now, when we have to ration capital, then it means we have to pick from a pool of profitable projects, the ones that return the most. And so let's look at an example here where we have projects 1 through to 5, different initial outlays, their various NPVs, their profitability indexes, and then the internal rates of return. So which projects, if any, should be selected if the capital budget, for example, is 100? So if you have 100 as your maximum capital available, then it means you go through and look at which one you can invest in. And that typically limits you to project 1, for example. If you have 200, then you may have to either do a double of project 1, if that is the case, or you do project 5, that is the case. So you have to make a choice. If you have, so what you really can look at is that if you were to do a double of project 1 for the 200, what would be your outcome? And if you were to do just project 5, which requires a 200, what would be the outcome? So these are things you need to do. So let's start by looking at, if we have projects, if we have 100, for example, so if our budget is 100, we pick project 1, which gives us an NPV of 20. If we have 200, we may still choose to pick project 1. It gives you an NPV of 20 because project 5 actually does not yield such a high NPV. Now, when we have 300, it means we can pick project 1 and project 5. And then when we have 400, we could pick project 1 and project 2. And we have 500, we could pick project 1 and project 2. So these are the optimal choices. So these are, so remember that the key is to maximize the total net present value given the limited resources or budgets that we have. Now, it's important that you also take cognizance of risk, because any investment, whilst looking at the return, must also take note of the risk in order to have a more comprehensive or decision point. Now, there are ways to go about the risk analysis. You can actually do what we call sensitivity analysis. And that means that you, after computing the initial NPV, you actually can hold a number of the parameters, all the parameters constant within the computations and vary just one. So for example, given that your NPV arises with the initial outlay, the revenue streams, your cost of capital, what you do is you find out what happens if initial outlay changes. And then you proceed and calculate what the effect will be. Then you proceed and also change to find out what happens if cost of capital changes. Then you also proceed to check what happens when the revenue stream changes. Now that gives you a sense of what can change over the project's life and what implications will have for the value addition effect or otherwise. Then we can also have scenarios where you can have worst case scenario, best case scenarios, all of these, sometimes looking at probability of certain occurrences. So we're going to have a scenario analysis, various scenarios with the expectations of what will occur. And then we can have a more complex case of what we know as simulation analysis. Usually that means that you're going to examine the effects of NPV when all the inputs are given certain probability distributions and allowed to follow them, so that you have a number of things changing at any point in time. Now that allows you to determine the distribution of NPVs and make a decision accordingly. Of course, part of the issue of capital budgeting means that you also post-audit, you sometimes would come face to face with the fact that you may want to scale down a project or given its profitability. So you scale down when maybe it's not turning out to be as profitable as anticipated. Or in the case where it turns out to be much, much more profitable, then you want to actually expand it. So yes, sometimes based on the expectations, you could decide to delay the investment based on what you do find. You could also decide to vary the size, whether you're going to expand it, abandon it, grow it, however, that also are real options. Then, of course, there's also the flexibility option that will allow you to alter operations, change prices, substitute inputs, etc. And of course, it actually has a fundamental option where you also allow the firm to alter the decision based on future events. So whether we're going to be drilling based on the price of oil, or we're going to be continuing with an R&D based on initial results, for example. So when it comes to real option, typically what you're looking at is options that allow you, the finance manager of a company, to enhance or alter the project's value with decisions sometime in the future. So based on extra information garnered into the future, you may decide to either delay, resize, alter a few things, or decide to abandon altogether. Now, there are some pitfalls that you have to note when you're doing capital budgeting. As much as possible, try to incorporate economic responses into the investment analysis. And then do not be misusing capital budgeting templates. Another thing is the use of pet projects. Pet projects are usually like projects that you find, enticing, and not because they're actually viable. And you should try not to base investment decisions on earnings per share, which is usually a flowing out of profitability or net income or return on equity. You should also try not to make decisions using IRR, because like we did mention, the issue of scale and multiple rates could be a problem. You should also be careful not to do some bad accounting for the cash flows. You should note overhead costs as they come and how to address them. And then you should learn to determine the appropriate risk-adjusted discount rate for the purposes of the capital budgeting. Now, aside that, you should also, as a finance manager, be careful not to spend all the investment budget just because it is available. And then there's a need to consider investment alternatives at any point in time. Now, handling sunk costs and opportunity costs incorrectly can lead to erroneous decision making. So you should be careful about these. So let's summarize. Now, when it comes to most firms, they actually try to use capital budgeting to select among available long-term investments. Now, that means they'll need to generate the ideas of approaches or investments that they can undertake. They analyze the various projects, and once they select, they plan the implementation of the project, and once done, they do the monitoring and evaluation to see whether they're on the right path. Projects can fall into many different types, whether you're replacing an existing machinery, you're coming up with a new product, but the principles of analysis are usually the same. Look for the incremental cash flows for each relevant period. Now, incremental cash flows do not explicitly include financing costs, but they are discounted at a risk-adjusted rate that reflects what owners require. So financing costs may not be captured in the calculation for cash flows, but once you're doing the discounting, this is taken care of. So methods of evaluating a project cash flow, typically we have the net present value and internal rate of return, discounted payback, and profitability index that are usually applying the discounted cash flow techniques. And then we also have the payback period and accounting rate, which do not, and they also have their pitfalls. So it's important to note that the overall goal for any finance manager is to add value to the firm. And in so doing, they must have the skill set to be able to identify viable projects from a pool of projects. And they should also be able to identify the relevant cash flows to be used and make the decisions that add on value. I think to a large extent, we've dealt with most of the issues and we understand what it takes to value the projects. When we meet in class, we're going to put more practice in what we have just learned. Thank you and have a nice day.